Good afternoon. Thank you for hanging out. I appreciate everyone's sticking around to hear this. I know I'm the caboose of today's festivities, so it is appreciated that you stuck around. My name is Scott Martinek. I'm an associate director out of our Tampa office. I've been with the PCAOB for 15 years and have been inspecting in the broker-dealer program. This will be going on my 11th year in the broker-dealer program. I am from Chicago originally. I'm still a die-hard Chicago fan, even though it's tough to be a Bears fan and a Cubs fan still. I do cheer for them over any Tampa teams. Mike Walters was supposed to be presenting with me today. Similarly, he had travel issues and was unable to make it from Charlotte. And I know he's watching, so he took the easy way out and chose not to dial in remotely. So he left me by myself, so here we are. All right, so let's get started. Maybe? There we go. All right, so first, the usual disclaimer. The views I express are in my official capacity as a member of DRI, but are my own and do not necessarily reflect the views of the board, any individual board member, or other members of the staff. And for this afternoon's objectives, as you can see on the slide, the goal here is that all of you and those online will be able to understand the relevant PCAOB publications that are out there to assist auditors of broker-dealers. We'll walk through a number of selected observations from our recent 2023 inspections and some requirements and illustrative examples. We'll go through some case studies and things like that. We'll touch on some insights regarding our inspection results over the previous 3 years. And then lastly, we'll touch on the status of our recently finished 2024 inspections and our upcoming 2025 inspections. Okay, so for all of you playing along, the code word right now is 232. And just as a heads up, this will be interactive, so keep your phones ready because, like I said, we have polling questions and a number of these code words throughout. So again, code word is 232. All right, so the first slide here we're going to touch on is some of those publications I had mentioned. These are just a handful of the many available publications that are online on our website. The first item being the annual report on an interim inspection program related to our audits of broker-dealers that was issued in July of 2024. Obviously, that relates to inspections that were conducted in 2023. As you're aware, most of you are aware of that report. But in addition to that report, we also do issue a supplementary information related to audits of broker-dealers that goes along with that. It is supplemental. It covers various themes and characteristics of audits that we've encompassed over a number of years. So for example, it'll cover audit firms, whether the firm audits compliant report filers, how many broker-dealer audits the firm actually performs, how frequently the firm has been inspected. It also hits on, for broker-dealers, whether the broker-dealer is an exempt report filer or a compliance report filer. The third bullet on the slide here, last January, we did publish our first spotlight as a broker-dealer program. The spotlight focused on insights from our inspections that may explain the level of deficiencies we are still seeing on inspections. We will cover some of those later on in the slide deck. And then finally, a dated but still useful publication from 10 years ago is the PCAOB Staff Guidance for Auditors of SEC-registered broker-dealers. This is an excellent and detailed document that walks through the application of certain PCAOB standards to broker-dealer audit and attestation engagements. And then lastly, not on the screen, but that has been touched on briefly by Chair Williams and others, and that we will touch on occasionally throughout. There are these new audit focus series that the PCAOB has issued that we'll highlight as we continue. All right, so the first slide, there will be a number of data. Hopefully you can see that. I know it may be small if you're sitting in the back where I was earlier. Overall, in 2023, we continue to see high deficiency rates in exam, review, and audit engagements. These elevated rates still cause concern And you can see on the slide, 70% of the audits that we touched in 2023, we found deficiencies, whether it was an audit or an attestation deficiency, up from 58% in 2022. Exam engagements also increased from 50 to 66 year over year, while the review engagements remains steady at 40%. The third column over that says audit areas with deficiencies, now while that may not be related to financial areas such as revenue or accounts receivable or whatnot, that's more of, could be audit committee communications, could be archiving of documentation, things like that. That's what's captured in that 8% there. And we'll get into each of these individually in more detail as we continue. All right, so financial statement areas. Again, apologize if you can't see that in the back. But what you'll notice here is revenue increased year over year from 34% to 48%. We had a significant increase in receivables and payable deficiencies identified from 13% to 36%, as well as the going concern area. We actually had 2 deficiencies out of 6 in the current year, and we had none in 2022. Revenue, obviously, as you would imagine, is our most inspected focus area, given the complexities that was already mentioned earlier this morning. We still continue to find deficiencies regardless of the revenue streams, whether it be commissions, investment advisory fees, M&A, other advisory fees. It runs the gamut. And a number of the areas that we find revenue deficiencies, the 3 primary audit standards are AS 2301, and that would be the response to risk. Occasionally, or most times, or often than not, that is a very broad statement, so it does encompass many things, but it really is getting at the engagement team's failure to respond to a relevant assertion for a risk that was identified during planning and whether they responded appropriately. The second auditing standard that we find deficiencies has to do with AS 2315, audit sampling. Here, the common deficiency is engagement teams will pick a sample based on a controls reliance approach, therefore reducing their sample size. However, when we evaluate the engagement team's control testing, we find deficiencies there, therefore having an implication on the sample size that was used as part of their substantive testing. Another one, and the last one I'll mention briefly, is substantive analytics, AS 2305. And here the common deficiencies we identify are the completeness and accuracy of the inputs that are used as part of those analytical procedures, the precision of those analytical procedures, or the relevance and the reliability of those things that are being analyzed. All right, I promised there would be a lot of these. Your next code word is 873. And then we'll dive into our first scenario. All right, so here's our first scenario. A broker-dealer reported merger and acquisition advisory fees of $10 million on its statement of income and disclosed the following. Merger and acquisition advisory fees were comprised of $8 million of placement fees and $2 million of retainer fees. Further disclosed, the retainer fees are earned on capital placement services and are recognized in accordance with the relevant contract. Retainers are non-refundable and offsettable against placement fees. For example, they reduce placement fees when placement fees are earned. Revenue from retainers is recognized when the broker-dealer has delivered the services as detailed in the contract. All right, now if you will, on your phones or online, which is the most significant factor in assessing the broker-dealer's recognition of that revenue or retainer fee under ASC 606? A, when the retainer fee is received. B, the nature and satisfaction of performance obligations in the capital placement contracts. C, the retainer fees are non-refundable. Or D, the retainer fees offset or reduce placement fees when the placement fees are earned. And I'll give you guys a minute to think that through. All right, let's move. Very good. Most of us got that right. The answer is B, the nature and satisfaction of performance obligations in the capital placement contracts. The auditor should evaluate the terms of the broker-dealers, mergers, and acquisition advisory contracts to understand the nature of the performance obligations associated with the contracts and when the broker-dealer has satisfied their performance. Just a couple of things to highlight here. Obviously, no one answered A. When the retainer fees are earned, just because you receive cash doesn't mean that revenue has been earned. I think that's fairly straightforward. One other thing I'll point out on C, the retainer fees are non-refundable. One of the things that I would highlight is that that revenue can be recognized when the contract has been terminated, if it's non-refundable. All right. As a reminder, the steps that apply in ASC 606 identify the contract, identify the performance obligations, determine the transaction price, allocation, recognize revenue when those obligations are satisfied. Typically, that's not a challenge for us in the broker-dealer world. However, the identification of the performance obligations, particularly for investment banking or advisory type broker-dealers, may not be as straightforward and is an area where we believe firms need to focus going forward. All right, and we are quickly going to dive into another scenario. This one relates to related party. We just heard a lot about related parties, both from FINRA and the SEC, so hopefully you will be able to answer this one appropriately as well. The broker-dealer is a member of FINRA and subject to intercompany expense sharing agreement with its parent and other sister affiliates where certain indirect expenses incurred by the parent are allocated to the broker-dealer and other affiliates. Indirect expenses subject to allocation are initially recorded in the general ledger of the parent. The parent allocates these expenses to the broker-dealer based on the methodology per the agreement. The engagement team determined that there was a risk material misstatement related to allocated expenses. Therefore, we know they have to do something. They've identified a risk. Indirect expenses may be rent, utilities, supplies, or whatnot. All right, so using your voting apparatus, whatever that may be. Did I go too far? There we go. Which procedure or procedures would be the best audit response to the risk of material misstatement for those allocated expenses? Obtain the intercompany expense sharing agreement and inquiring of the broker-dealer management regarding those allocated expenses. B, evaluate the expenses recorded by the parent that were subject to the allocation methodology. C, evaluate the reasonableness of the allocation methodology and whether it was accurately applied. Or D, a combination of A, B, and C. All right. Oops, we missed. There we go. And 87% of you answered correctly. The answer is D. AS 2410 obviously provides requirements that you are, as auditors, to identify and address risks associated with related parties, including whether the company is properly identified, accounted for, and disclosed its related parties and relationships, transactions with related parties. Typically, a combination of those procedures, like A through C, would be necessary to respond to the risk of material misstatement of expenses allocated. However, keep in mind that if fraud or other significant risks are identified related to allocated expense, the auditor's response should specifically address those risks. All right, our next topic of discussion is journal entry procedures. This is another area where we continue to identify deficiencies related to the examination of journal entries by engagement teams. Common areas of deficiencies, as you can see on the left here, include not obtaining an understanding of the financial reporting process and controls over journal entries and other adjustments, not identifying and selecting journal entries for testing to address the potential for material misstatement due to fraud, not testing the completeness of the population of journal entries. So, for example, an engagement team does pick a sample, but they did not verify that the population that they picked from was complete and accurate, either through roll-forward testing or some other means. Not testing any of the journal entries that met the auditor's fraud criteria and or limiting its procedures to certain entries meeting its fraud criteria without having an appropriate rationale. So we do see that occasionally where engagement teams, they go out, they have their criteria, they get a slew of responses back from their evaluation, and they choose to pick or choose which ones they're going to look at without a proper rationale to address those. And then lastly, not evidencing an appropriate rationale for how certain factors in AS 2401 resulted in the identification of its fraud risk criteria, including the consideration of manual versus automated entries. Now, with that being said, on the other side of the screen, you'll see we have observed good practices as part of our inspections, and we'd like to highlight those as well. Many teams and firms require the use of IT specialists with specialized skill or knowledge in IT. They can be useful in evaluating the firm's financial reporting process, assisting with testing of those IT controls or identifying automated journal entries, determining which journal entries are manual or automated, and when testing completeness of the journal entry population subject to sampling or testing, not sampling. And we've come across firms that have provided guidance with examples to their teams. These guidance typically provide characteristics of potentially fraudulent journal entries to be mindful of when testing, selecting journal entries. Training, we've come across numerous trainings at various firms that provide training for all their partners and firm personnel on AS 2401, including journal entry testing, of course. There are journal entries practice aids, structured templates to assist engagement teams in determining the documentation, documenting the basis for selecting journal entries to test. Audit firms utilize practice aids, which include guidance on requirements of AS 2401, criteria that can be used to select journal entries for testing of entries that meet selected criteria, and of course, documenting it in an appropriate way. Some firms use this review program on the bottom there, where they have pre-issuance review programs where a team of folks or individuals will come in and ensure that journal entry testing was performed appropriately and adequately prior to the sign-off of the opinion. And then lastly, software audit tools has become more popular to aid engagement teams in testing the completeness of not only the journal entry population, but also in identifying journal entries with fraudulent characteristics. All right, so here we have audit focus. Those items that we just walked through on that previous slide, they did come directly from this audit focus that was issued in January. It's a PCAOB staff audit focus on journal entries. I believe Chair Williams spoke on this as well as the small firms group. It is meant to be an easy to digest information for auditors. It's very limited in focus. Reiterates auditing standards and staff guidance, as well as offers reminders and good practice. Again, in addition to the common deficiencies and good practice that we just walked through, this edition highlights key reminders for auditors from the PCAOB standards related to testing of journal entries, provides the staff's perspective and on the common deficiencies made by auditors. And again, this is available on our website. Okay, so that really was the financial statement audit side of the house. Now we'll get into the attestation side, and we'll start here with the review engagements. As you can see on the screen, and mentioned earlier, the review engagements, the percentage of deficiency remained flat at 40% year over year. And as we know, there are a variety of reasons why a broker-dealer might assert that it is not required to comply with the customer protection rule. We do still see two primary deficiencies that we come across with respect to engagements that are done under the review AT2. Most of the review engagement deficiencies identified in the previous year concerned auditors that did not take into account and evaluate evidence obtained in the audit of the financial statements that contradicted broker-dealer assertions and exemptions. And I think we just kind of heard about this through FINRA. A common example is a broker-dealer that asserts that all of its customer-related business is conducted through a clearing broker under K2II. But the financial statements or the work papers indicate that the broker-dealer is engaged in customer securities that go beyond or outside of K2II. So maybe they're doing mutual fund business and prompt transmittal, and that would be above and beyond K2II or whatever the case may be. So that would be one of the deficiencies, primary deficiencies we identify. Another one is really auditor review reports that do not accurately identify the assertions made by the broker-dealer. So there's a disconnect between what the broker-dealer has asserted and what's included in the firm's review report. And we'll get into an example of that right now. So your next scenario. The broker-dealer disclosed in its financial statements that it cleared all customer security transactions through an unaffiliated clearing broker on a fully disclosed basis and did not carry customer accounts or perform custodial functions related to customer securities. The broker-dealer included the following statements in its exemption report. It claimed an exemption from K2II, defined as the exemption provisions, and it met the identified exemption provisions throughout the year, except in 2 instances when customer checks were not promptly transmitted to the clearing broker. All right. So here's the question. Which of the following statements would be incorrect? A, as the securities deficit report is referenced in the SOC 1 report. Wait, we're on the wrong one. I went too far. This is very touchy. I think we have the wrong slide here. Yeah, we have the wrong slide here. Okay, well, let me read it to you. The polling question should have read, I don't know if it's in there somewhere, based on the scenario, which of the following statements would be inappropriate for the auditor to include in its review report? We have reviewed management statements included in the company exemption report in which the broker-dealer stated, A, it claimed an exemption from K2I, B, the broker-dealer did not directly or indirectly receive, hold, or otherwise own funds or securities to customers, C, the broker-dealer met the identified provision throughout the year without exception, or D, A, B, and C. Obviously, the answer would be D because they claimed a K2II and not a K2I, and they did not meet the provisions as they disclaimed. Sorry about that. All right, so let's move on. So your next code word is 320. And we'll talk now about exam engagements, AT1. The percentage of exam engagements did increase slightly from 2022 to 2023. Most of these deficiencies on exam engagements related to the testing of design and operating effectiveness of controls important to the auditor's conclusion regarding the effectiveness of ICOC. The financial responsibility rules help protect customers of broker-dealers, for example, by ensuring adequate funds are held in reserve to cover balances that broker-dealers owe to their customers or that information provided to the customer in their account statement is complete and accurate. We do identify ICOC deficiencies related to all 4 financial responsibility rules, reserve requirement rules, possession or control requirements, account statement rule, and the quarterly security account rule. Some of the most common ICOC-related deficiencies involved testing of the completeness and accuracy of reports, whether those were produced by the broker-dealer or the service organization, something to keep in mind when evaluating those. ITGC controls, upon which the effectiveness of other important controls are relied upon, tends to be another deficiency that we come across often. And then lastly, testing of review controls by management and whether the nature and timing of those are at the appropriate precision, whether the engagement team has evaluated the criteria that is being used by that reviewer, and whether those have been adequately evaluated as far as effectiveness. So let's walk through a brief scenario of that, which may be out of order as well. Another code word, 503. I think because I was the last session, they wanted to make sure everyone was paying attention, so I got all the code words. Code word 503. All right, so far so good. This is the scenario. Okay, scenario AT1, a broker-dealer used a service organization for trade processing and maintenance of customer account information, and the broker-dealer's stock record, The service organization generated the securities deficit report that the broker-dealer used in the performance of controls related to its compliance with possession or control requirements. The auditor determined that the controls at the service org were important to its conclusion about the broker-dealer's ICOC. The service organization's SOC 1 report provided evidence of the design and operating effectiveness of the controls over the completeness and accuracy of that deficit report. The auditor determined to rely on the SOC 1 report for evidence regarding controls over the securities deficit report. We'll see if that's in there twice or it's out of place. Okay, it's in there twice. All right, so polling question again. This is the right one. Which of the following statements would be incorrect, so not correct? As A, as the securities deficit report is referenced in the SOC 1 report, the auditor does not need to perform any additional procedures. B, the auditor may inquire of the broker-dealer to understand its assessment of the SOC 1 report and any implications for its assertions regarding the effectiveness of its ICOC. C, the SOC 1 report may provide information regarding controls upon which the securities deficit report controls are dependent. Or D, AS 2601 could assist the auditor in understanding the evidence provided by a service auditor's report. Yeah, that one's missing. Yeah, I don't think it's in there because it was after the first one that was supposed to be there. All right, so what do you think? Everyone thinks A in the audience. Unfortunately, those online can't answer. A is correct. It is the incorrect statement. The auditor will need to assess the evidence provided by the SOC 1 report and consider the risk factors associated with the controls. For example, the SOC 1 report may indicate that the controls over the deficit report are dependent on other controls, such as ITGC controls at the broker-dealer. Also, the facts don't indicate the results of the service auditor's procedures over the deficit report. It could have had issues that were not given in the facts. The auditor will need to consider those results and implications for the broker-dealer's ICOC. The others are obviously correct. The one thing I would point out is D, AS 2601. Typically, audit standards are not relevant for attestation engagements. However, it was added it could be informational that would be helpful to engagement teams when evaluating the SOC 1. How am I doing on time? I think I'm good. All right. Supplemental information areas. Here, this is going to be AS 2701. Percentage of engagements with deficiencies related to supplemental information increased just slightly. Supplemental information is required to be included in the broker-dealer and annual reports by the Customer Protection Rule and the Net Capital Rule. The Customer Protection Rule requires the presentation of customer reserves and possession of control schedules in the broker-dealer financials, while the Net Capital Rule requires presentation of the Net Capital Schedule. Again, applicable PCAOB standard is AS 2701. And generally, these deficiencies fall into two broad categories. First being insufficient procedures to test the completeness and accuracy of information on the schedule itself. So for example, net capital, if there's something, an amount reported on the net capital schedule, engagement teams are failing to actually test the completeness and accuracy of that information. The second nuance of that same line would be that the information produced by the broker-dealer or a service organization in calculating that is also not tested for completeness and accuracy by the engagement teams. So that would be the primary first category, I would say, of deficiencies in this area. The second is really whether amounts presented were determined in compliance with the applicable rule. So again, keeping with the net capital rule, whether things were deemed allowable or not allowable based on the rule, and whether those have been adhered to by the broker-dealer and tested by the engagement team. All right. So here is that one column I mentioned briefly on the initial the table. These are non-compliance with PCAOB standards. For those of you who have been inspected in 2023 or this past year, 2024, we did, as a division, begin inspecting general inspection procedures to facilitate consistent performance of review procedures related to various topics from most of the broker-dealer audits and issuer audits as well. This slide summarizes instances of non-compliance with our standards through those identified through those procedures. These topics do not relate directly to the sufficiency or appropriateness of evidence firms obtain to support their audit opinions, but I would call these more general binder type findings, for those of you who remember general binders or things of that nature. So I'll highlight four on the slide here. We'll first start with audit documentation, which is the second from the bottom. We found 16 engagement deficiencies through our inspection procedures. Again, as you would imagine, most frequently these involve engagement teams' failure to compile a complete and final set of audit documentation for retention within the 45-day period. Many times, while doing the inspection and preparing for the inspection, engagement teams happen to identify critical work papers that were not included in the final set, which would result in that finding. The second item on the screen I'll highlight for you is the auditor's report. That is the bottom there. Most frequently, this involves when firms omitted or did not properly present required elements within the actual audit report itself, or the auditor's report on supplemental information in accordance with AS 3101 or AS 2701. Again, a common example here, I've seen it many times in the past 2 years, is the supplemental schedules were not properly referred to in the opinion, and therefore it wasn't clear as to what they were opining on. Sometimes firms would tend to use letters that were applicable to a table of contents that was in the broker-dealer's financials, and they didn't realize that the broker-dealer had actually changed the numbering in the table of contents, and therefore it didn't align with what they were opining on. The third item here I'll point out is audit independence on the top. We found 11 engagement deficiencies in 2023. Here, most frequently, this involved instances where the firm did not provide audit committee or their equivalents the required independence communications in accordance with Rule 3526. And this is different than independence matter I'll touch on in a few minutes. And then lastly, audit communications, the third from the bottom there. Again, we found 13 engagement deficiencies. Most frequently, this involves instances where firms did not communicate to the audit committees or their equivalent all significant risks that were identified during the risk assessment process in accordance with AS 1301. And again, another plug for our audit focus. Again, we have an audit committee communication audit focus that is out there solely directed at engagement teams' communications with the audit committee. Again, it's for key reminders from the PCAOB standards and staff regarding relevant standards and risks and things, PCAOB staff perspectives on common deficiencies, good practices that staff has observed, So that was issued in December of 2024, and again, it is on our website for you to find and use to your leisure, pleasure. All right, so here's the other auditor independence. And this one is, I would say, a little more significant. Here we had one finding, however, it is significant. We just want to remind those of you here and those of you online, firms should be diligent in complying with the independence requirement rule of Reg SX. Broker-dealers should be concerned with potential noncompliance with SEC and PCAOB independence rules because if the auditor's independence is impaired, then the broker-dealer has not satisfied the requirement to file financial statements audited by an independent registered public accounting firm. Hopefully that is clear. And really what this represents are known PCAOB independent violations or presumed SEC independent violations. So in this instance here, I believe it was, we came across a firm that was completing and preparing the financial statements for their broker-dealer. We've been better at that as a community, but apparently someone missed that, and so we identified that. So just a friendly reminder that that is frowned upon. Another code word. This is code word 671. 671. And now I'll get into the spotlight. So how many folks here have seen the spotlight? I've read the broker-dealer spotlight. I know most of us left our broker-dealer somewhat. Again, this is a plug, something new that we did issue in January 2024. It is very different than our typical annual report. This covers more of what we believe is really driving the deficiency rates and what engagement teams should be on the lookout for when you are conducting your audits. We continue to believe, however, that the points covered in this spotlight remain relevant for broker-dealer auditors today, even though this may have been covered in the previous forum. All right, so first item, insufficient understanding of the broker-dealer industry. This does continue to be a concern of the program, that engagement teams may have an insufficient understanding of the broker-dealer industry in which they're performing their audits. There are moments on the inspections that cause us to question auditors' understanding of the broker-dealer financial responsibility rules. For example, work papers that don't cite rules in relevant places, again, evaluating net capital, allowable, not allowable assets. You would assume that they would cite the rule that is why it's there, or included or not included, and we don't see that there. An inability to respond to questions regarding what rule or interpretation of the rule was considered when they're performing their test to reach those conclusions of, again, sticking with the net capital rule, allowable and not allowable. Not understanding or challenging positions taken by the broker-dealer that one or more financial rules don't apply to them when it's not readily apparent why it would not be. So they're just overly relying on the broker-dealer and management as to why a rule may not apply. And then lastly, not being able to describe the requirements or differences between various exemptions and or the use of footnote 74. Understanding the broker-dealer's operations and source of revenue is also critically important. Sources of information that can assist in understanding the broker-dealer's operations include membership agreements, broker check, process and control procedures, documents, and written supervisory procedures. Understanding revenue recognition policies is another area where we question engagement teams' understanding at times. Examples include when revenue work papers don't contemplate ASC 606. For example, they're not identifying the customer, the applicable contract, the transaction price, whether there are one or more performance obligations or how those obligations are satisfied, and how that aligns with the broker-dealer's disclosed revenue recognition policies in their financial statements. Sometimes those factors may be straightforward to identify, but some broker-dealers engage in multiple lines of business that necessitate a detailed analysis of the ASC 606 principles. The next topic we'd highlight is professional skepticism, or the lack thereof. PCAOB Standard 1015, due professional care in the performance of work, states, among other things, that due professional care requires the auditor to exercise professional skepticism. However, we continue to identify lack of due care and professional skepticism. For example, as you'll see on the screen here, reliance on management inquiries without corroboration. For example, management indicates significant deficiencies or material weaknesses have been remediated, but the team does not obtain evidence about the new implemented controls and whether they are truly effective or not. Risk assessment, not inquiring of individuals who may have knowledge about fraud, alleged fraud, or more significant accounts. For example, not testing or one or more significant accounts simply because they are not allowable for net capital. Errors and omissions from auditors' reports, for example, misidentification of the basic financial statements, as we previously discussed, or the supplemental information, and not identifying departures from GAAP. Instances where broker-dealers have not implemented new accounting pronouncements, such as the new lease standard, or obvious errors in cash flow statement misclassifications. The next item highlighted in the spotlight is the lack of rigor in risk assessment. Here are a few examples we have observed of how engagement teams may not appropriately assess risk and internal controls associated with their broker-dealer audits. Assessing the overall risk of material misstatement and financial statements to be low without completing the required steps and procedures at the financial statement and at the assertion level. Asserting that SEC and FINRA only care about the net capital supplemental information and therefore the basic financial statement inherent risk should be low. Citing automation and reliance on technology as factors that support lower risk assessments without considering the risks associated with the controls and processes at other entities that the broker-dealer may rely on. Defaulting to a control risk assessment of maximum for all significant accounts without obtaining a sufficient understanding of the broker-dealer's process and controls for significant transaction cycles. Ignoring relevant external factors such as economic conditions, changes in regulatory environment, and company-specific factors, and or limiting identification of significant accounts and their relevant assertions to quantitative factors without proper consideration of the qualitative aspects. All right. And then two more. Over-reliance on standardized audit programs. Obviously, a number of firms use standardized audit programs that are purchased or self-created by the firm. In our inspections experience, standardized audit programs generally provide the user with the text of a PCAOB requirement and associated references to the standards themselves. However, there can be risks with their use. For example, these tools may not be all-encompassing. For example, an engagement team will use information by the broker-dealer as audit evidence, but does not address 1105-10, the requirement to evaluate whether the information is sufficient and appropriate for purposes of the audit. May reflect only certain criteria in the standard. Again, back to the journal entry, for example, some standard audit programs remind engagement teams to select and test journal entries. However, they don't include the many factors to consider with the PCAOB standards when determining which entries to test. And then lastly, may be limited in scope of procedures to be completed. The audit procedures and revenue may be written generally such that they can apply to a wide range of revenue streams. However, the nature of the necessary procedures to test certain revenue types will differ, obviously. I think the takeaway here is that while the standard audit programs may be effective tools, the procedures may need to be tailored to address the risks associated with your particular broker-dealer client on your broker-dealer engagement. And then lastly, ineffective EQRs on engagements. We continue to come across this where inspection results may indicate that some of the EQR reviewers are not sufficiently knowledgeable of GAAP or the industry itself, are not reading the financial statements carefully enough, or are reluctant to challenge the engagement team. Examples of deficiencies that call into question the effectiveness of the EQR include insufficient audit responses to areas of significant risk, often including revenue, of course, Errors or inconsistencies in the financial statements. For example, supplemental schedules don't agree to the basic financial statements, so net capital doesn't agree to equity. Internal inconsistencies, cash flow statements versus the balance sheet. Omitted revenue recognition disclosures. I've come across where balance sheets don't foot. They balance, but if you were to add them up, they don't foot. And the partner didn't catch that, the EQR didn't catch that. That would raise questions as to the effectiveness of the EQR. Errors or inconsistencies, and then the audit report, again, as mentioned previously, the misidentification of basic financial statements in the report or the supplemental information, and mischaracterizations of management's assertions in the attestation report. It should be fairly simple, you would think, to match those two items up, but it still seems to get missed. One thing to note, while retaining a qualified EQR from outside the firm is obviously an appropriate way to address the lack of a qualified EQR within your firm, firms can develop EQR capabilities in-house through a combination of on-the-job training, in-house and vendor training sessions, broker-dealer conferences, and dedicated self-study of the financial responsibility rules. All right, so again, I understand just based on the layout of the room here, hopefully it's better online. This may be a hard graph to follow, but we'll highlight what's important here. Our inspection results suggest that experience with PCAOB standards do matter, whether that experience is derived from broker-dealer audits or issuer clients. Another way to think about experience is hours spent on PCAOB engagements. With each incremental engagement hour, there is an opportunity for the staff of your firm to gain experience. This slide summarizes self-reported data from the firms regarding hours incurred on engagements that the PCAOB did in fact review during its inspections. The data covers the 2020 through 2022 inspection years, which covers our review of 289 audit engagements. I'd highlight for you the dark blue graph bars, as these represent engagements performed by firms that did not also audit public companies. A significant number of broker-dealer engagements are performed by such firms every year. Those firms spent less than 100 hours on approximately 65% of the audits performed. Many of these were performed in less than 40 hours. That's the first large blue graph. We cannot say that the PCAOB compliant engagements combined cannot be performed in less than 100 hours. That is not what we are saying. We have certainly encountered many broker-dealers through our inspections that appear to have been fairly straightforward business operations or even no revenue-generating activities. But we have also seen broker-dealers with multiple lines of business and detailed financial statements and disclosures in this less than 100-hour category, and we obviously consider this a red flag. All right. Pace of auditor changes. This slide summarizes the pace of auditor change using self-reported tenure data by the firms inspected by our 2022 inspection year. Approximately 1/3 of the broker-dealers audited by firms we inspected in 2022 had changed auditors in the last 3 years. There's no maximum or minimum tenure that is most appropriate, obviously. However, an auditor change is an event that is likely to influence audit risk, so it will be a factor that we continue to look at as part of our oversight activities. For those of you in the back of the room, the top line says more than 10 years, and it's roughly 25%. 3 to 10 years is roughly 38%. 1 to 3 years is back to maybe 22%. And then the bottom two read between 6 and 12 months and less than 6 months. One other thing to note here on this slide, in addition, during our inspections, we have observed that some audit firms appear to have taken on more broker-dealer clients than they can adequately serve with the available resources, including partner level. This is especially true considering the concentration of broker-dealers with December 31 fiscal year ends and the corresponding filing deadlines. Some firms are growing their broker-dealer practice by taking on clients from firms that have been barred or otherwise sanctioned. We encourage firms to give such circumstances appropriate consideration in their client acceptance procedures and in assessing the reliability of prior financial statements from the predecessor firm work papers before taking on those clients. All right, your last bar graph of the day. This is audit fees and deficiency rates. Inspected firms also provided broker-dealer client fee data for all broker-dealer clients regardless of whether the engagement was reviewed during the inspection. One observation from the data is that for firms, other than the largest firms, approximately 65% of broker-dealer audits were performed for less than $25,000, including 34% for less than $10,000 and 10% for less than $5,000. This is data from 2020 to 2022. The chart on this slide also overlays deficiency rates with audit fees. It illustrates that deficiency rates are high across all fee ranges during that period, and for the period since broker-dealers have been required to undergo audits and exams or review engagements in accordance with standards. The highest deficiency rates are in the $5,001 to $10,000 fee range, which is the second from the bottom for you in the back, with 79% of audit engagements found to have at least one deficiency during that period compared to 89% since the PCAOB standards have been in effect. These percentages raise concerns that the audit firm's focus on achieving profitability on such engagements may adversely impact the hours partners and staff allocate to planning and field work with heightened risks to audit quality. I think that goes without saying. Another code word, 658. And finally, 2024-25 inspection update. The data that we just walked through obviously covers our inspection results through 2023. Our 2024 report has yet to be issued, therefore we aren't making any statements on that. But during 2024, we conducted a similar number of inspections as we did in 2023. We inspected 60 firms and 103 audits. Field work for those inspections is now complete, and we are nearly complete with the communication of comment forms to those inspected firms and adding responses received from and addressing responses received from those firms. We did increase the frequency with inspections that were conducted at firm locations in 2024 compared to 2023. I envision that will continue to increase in the current year. Our 2024 results will be made publicly available no later than July of 2025 in compliance with PCAOB Rule 4020T. Looking ahead to the current year, 2025, we have recently completed our initial selections of firms to inspect and engagements to review. Our notification of firms initially selected for inspection is now underway. Field work began last month and is expected to continue through most of the year. As always, we appreciate your cooperation with the inspection process. In 2025, we expect to perform more inspections on site at the firm's locations than we did in 2024, but we will continue with fully remote and hybrid inspections as well. I know I personally find a great deal of efficiencies and effectiveness when we are out in the field dealing with the engagement teams in person. I think it's easier to have one-off conversations. It's easier to whiteboard things if you're on a complicated area. I know the firms that I've been on have really pushed for us to be in the field. Not that is a requirement, but I certainly think there's benefits to that. Hopefully you do as well. And I think you can continue to see us asking and pushing for that as we move forward more frequently. But it's certainly, I believe it's your discretion. And with that, I think we'll move to questions. And I do have, looks like one. The question here is the broker-dealer deficiency data broken down by size of firm and number of broker-dealer audits anywhere? And that would be a great question for Mike, who is not here, because he does lead our 4020T and does slice and dice the data. So I'm not sure I have that answer in front of me, unless Mike wants to text me while we're sitting here. Again, the question, Mike, if you're listening, is the broker-dealer deficiency data broken down by size of firm and number of broker-dealers audited anywhere? If I had to guess, that would be in the supplemental report that we issue alongside the 4020T that we referenced on slide 4. There is a supplemental information that does break out certain statistics, so that would be where I would encourage you to look at if that information is in fact available. And I don't have a text for Mike. So with that, again, appreciate you hanging in there. I know it's the end of the day. It's been a long day. Thank you for your attention and your patience.